Good morning, everybody. Good morning and happy Monday, all you magnificent melon heads of the world. Today is June 3rd, 2024. A new week, a new month is upon us. And what better way to start the new week, the new month, than Gamestop? Roaring Kitty. He's at it again. Folks, this is a deeply unserious market. So let's get into a deeply unserious story to lead off the day. Keith Gill, a.k.a. Roaring Kitty, a.k.a. Deep Effen Value, finally posted to Reddit again. And rather than a few weeks ago when he just posted that kind of weird like lean-in meme, sending GameStop and AMC rallying and everybody piled in, and then predictably those companies just issued a bunch of new shares and diluted all their new shareholders, and then the stocks came predictably right back down. And so ultimately, the first few people who got in made money and everybody else lost. Well, unlike that, Keith Gill's actually on Reddit now, not just posting a meme on X. He's in Reddit, and he actually posted supposedly a screenshot of his positions in GameStop. And they're freaking huge. How big? $115.7 million as of about 12 hours ago. He's got 5 million shares of GameStop stock. 5 million shares, which at the time he posted it was worth about 115 million. Of course, right now it's worth closer to 200 million because GameStop is up 70% this morning. At one point, it was up almost 80%. But it wasn't just those shares that's got everybody's attention. And I think probably the more important part of that post was his 120,000 June 21st $20 call options that he also posted. At the time, that was worth about $65.7 million. Again, that was 12 hours ago. That's worth something like $500 million now. Again, we won't know until the options market opens up, but these are now deep in the money calls, so I don't know if there's going to be any premium left attached to them. We'll see. But obviously, Keith Gill is making some money this morning. That stock is rallying 70 to 80%. Is it going to last, or is this going to be another spike that everybody sells into, takes profits, crashes right back down, issues new shares? Who knows? But look, folks, this is, as I said earlier, this is a deeply unserious market. All right. There is money just sloshing around. The Fed is supposedly tightening right now. I keep hearing how restrictive monetary policy is, and we might need to keep our monetary policy in restrictive territory for longer. But you know what? The money supply is growing again. How's that happening? How is that restrictive if we have the money supply growing? And why is the money supply growing? Banks aren't making more loans. We just got done bank earnings. And most banks are cutting back on their lending because their net interest margins are getting squeezed by the higher short-term interest rates and the lower long-term interest rates. So how is the money supply growing? Where is this money coming from? I still don't know. I've shouted this into the ether several times now. The Federal Reserve is still destroying somewhere around $60-70 billion a month. And yet the money supply has grown by $300 to $600 billion over the last 6 months or so. So we've got like somewhere between $500 and $900 billion that we can't account for that just poof, it appeared, it existed. Where's it coming from? The banks are not lending it. The Fed is not printing it, at least not directly, not that they're telling us. Is it coming from the plunge protection team? Is buy now, pay later 10 times as big as they're claiming it is? Is private credit loaning hundreds of billions of dollars into existence to keep zombie companies alive? I don't know where all this extra money is coming from, but I do know it's out there, and that's why reverse repo stopped falling, and that's why we've got things like people putting hundreds of millions of dollars into GameStop, which, look, guys, I like to see the apes win. I want to see GameStop going up. I actually still own a little bit of GameStop. All right, so there's my disclosures. I own a little bit of meme stocks. I want to see them go up. I want to see the little guys win. But let's face facts, guys. These are zombie companies, right? The movie theater is a dying business model. Hollywood is a joke. The writers went on strike, and I don't think anybody even noticed because the writers don't know how to write anymore. They probably got AI writing the movie scripts for you now. GameStop, are people really buying used video games that much? Look, I'm going to evoke the wrath of the apes. I get it, but guys, at the end of the day, it's a business model that sucks. It's a done business model. And yet the naked shorting, and you probably got a gamma squeeze going on now, and that's why the shares are running high double-digit percentages. At the end of the day, do you have a company that makes money? No, you don't. Not really. I mean, they were profitable for about a quarter, and then they swung back to a loss. It's a deeply unserious market making deeply unserious moves. If you're on the right side of it, congratulations. Be careful. Watch your loss. I mean, the algos can come in. They'll take away the buy button, or they'll issue more shares. We've seen it how many times. They will take away the punch bowl sooner or later. Also going on this morning, we got a lot of movement happening in China. But it's not the movement we thought we were going to get. There's a lot of people are out there calling a bottom in China, notably like the Gates Foundation. I talked about this in my DNN news update last week, that the Gates Foundation is selling Microsoft stock, and they were buying things like Alibaba, things like Baidu. They were basically kind of suggesting a top in U.S. tech and a bottom in China stocks. And we've also had a rip and rally in the Chinese bond market as Chinese investors flock to safety. We've also seen gold and silver have rallied tremendously in this flight to safety in China, because the average Chinese investor doesn't trust what's going on in their stock market, doesn't trust what's going on in their high yield bond market, because those companies are garbage and they've got a property bubble that's bursting. So you've had a flight to safety in China, and you've also had a little bit of front running. A lot of people are just treating it like it's already carved in stone, that any day now the People's Bank of China is just going to open the floodgates of liquidity, and the stimmies will flow and yields will plummet and the free money will be falling from the heavens. Everybody is expecting that. And yet the PBOC, through state-controlled media a few days ago, actually put out a big warning saying, cut this crap out. If you guys keep doing this, we're going to sell bonds, not print money and buy bonds. China's central bank is threatening to destroy liquidity right now, when everybody in the world is saying they're about to flood the market with liquidity. Be careful. When everybody is saying the same thing, usually the opposite happens. So watch out what's going on in China this morning. I was very surprised to see that, to see the Chinese warning of selling some of their domestic bond holdings in order to remove liquidity from markets. And in other words, their investors are flooding to safety. You know, it's kind of like, oh, they're hiding in the tunnels beneath the city. And they're like, well, then we're going to flood the tunnels and drown everybody that's under there. Jeez, it's dark what's going on in China here. But I don't think anybody is really expecting the Chinese to come start sucking liquidity out of their bond market. Certainly not Paul Krugman, the Keynesian that he is. He's in the press saying, I don't understand why China doesn't stimulate demand. Why doesn't a country who's suffering from a speculative asset bubble pump more easy money into that bubble? I'm Paul Krugman. I won a Nobel Prize. I don't understand why the answer to every problem isn't just print money and more big government. Well, that's Paul Krugman. Everything looks like a nail to him. He is the Keynesian hammer. Also this morning, I saw an interesting article about Warren Buffett. While we're talking about stocks rallying 70%, and obviously we've got the AI bubble going on and everything is at an all-time high. You know what else is at an all-time high? The amount of cash that Warren Buffett is holding. And I think a lot of people fail to appreciate just how big that cash position is. Warren Buffett controls 3% of the entire global market for U.S. Treasury bills. That's how many T-bills he owns now. $158 billion he's got in U.S. Treasury bills. That's U.S. government-issued bonds from 1 year or lower in duration. $158 billion. He's actually got $182 billion in cash. More than 20% of Berkshire Hathaway's total holdings are in dollars or dollar equivalents right now. One of the most famous investors of all time has never been more bearish than he is at this moment. Meanwhile, retail is piling in hand over fist. See also Roaring Kitty. Guys, take from that what you will. To me, that is a very big warning sign. Also going on, we got some data from Macro Edge this morning. Shout out to @MacroEdgeRES on X. Fantastic feed. You guys should be following it. May's job cuts tally is in. 95,746 job cuts and layoffs were announced in the month of May by U.S. companies. MacroEdge runs they keep track of that throughout the month, and then they give us a total at the end of the month. That is down slightly from the 114,752 that we had in April, although much higher than the 73,000 that we had in March. And as MacroEdge pointed out, there was a holiday at the end of May, so a few fewer business days, and companies tend to be less likely to lay people off heading into a holiday. So that's actually a pretty alarming number, 95,000 job cuts. We get non-farm payrolls later this week. On Friday, I believe, is when we get the non-farm payrolls number. And that's going to be another one of those market holding its breath moments. What is the non-farm payrolls going to do? Let me know in the comments what you guys think. Are we in for another one of those 200,000 or 300,000 job gains, and then we're going to quietly revise it later? Or are we going to keep up with this trend? The last jobs number we got was surprisingly low. What was it? 175,000, I think, was the number we had in the last non-farm payrolls number. It was a big drop from where we had been used to. And then if you look at some of the things we're seeing, like slowdowns in consumer spending showing up in GDP, retail sales flat month over month, a lot of those layoffs that MacroEdge spotted were layoffs in the restaurant industry, somewhere that a lot of these job gains that we've seen from the last year have been in low-wage part-time jobs. Are we going to be in for another big shocker to the downside? We'll know on Friday. My gut tells me we're going to see another low jobs number and a higher unemployment number. Will we break that 4% unemployment threshold? That's the question there. And also keep an eye on the banks. The FDIC's problem bank list is out, and the number of banks that the FDIC is keeping an eye on is on the rise, and the total number of assets in those banks is on the rise even faster. So we're going to take a look at that chart. I don't think our problems in the banking system are quite over with. Got a lot to cover today, guys. Why don't we shrink my big melon of a head and let's take a look at what's going on in this market. And while we do that, don't forget that like button and that subscribe button next to it. If you're new here, come have your coffee with the melon heads every morning as we go through markets. And the fear-greed index is sitting here pegged right in the middle at 49 neutrality. Does it feel like a neutral market? This market does not feel neutral to me. Let me just go ahead and say it. I'm not doubting the indicator here, but we check in on this like once a week just to see what the sentiment is. It's saying neutral, but this market seems unbelievably greedy to me at this moment in time. The S&P, though, is up 16 points this morning, about 0.3% to the upside. The Dow, meanwhile, is down 3 points, so basically unchanged here in the Dow this morning. And the NASDAQ is up 104 points. Oh, is it sell everything and buy NVIDIA day again? Oh, I didn't even get you guys a present. I'm sorry. Happy sell everything and buy NVIDIA day. The NASDAQ is up another 0.5% just because the market is open. And the DXY is actually down about 10 basis points this morning at 104.57. So that's slightly weaker dollar. Will put some upward pressure on stocks this morning. Looking over at yields, we got yields are heading lower along with that weaker dollar. The 30-year Treasury is down 4 basis points at 4.611. The 10-year Treasury, 4.467%. That's down almost 5 basis points. The 2-year Treasury is at 4.870, down 2 points and change. And the 1 month is at 5.365. That's also down a fraction of 1 point. Looking over at the commodities board, we got metals catching a little bit of a bid this morning. Spot gold is up $6.26, or about 0.25% to $2,333 an ounce. Spot silver is at $30.54. That's up about 13 cents here, or 0.44%. We're going to take a look at that silver chart in just a moment. Copper is at $4.69 for July futures. That's up a little less than a dime this morning, 1.8%. July platinum futures at $1,038. That's down about $3. September palladium futures at $927.53. That's up $14 or 1.6%. And oil is down a little bit here, about 43 cents for July WTI futures at 76.56. Let's talk about oil for a minute here. Oil prices slipped despite OPEC Plus production cut extension. OPEC Plus got together over the weekend or late last week, and no big surprises there. They extended the voluntary production cuts that were already in place. The market was largely expecting that, so it wasn't really an oil price moving event because it was pretty much already priced in. If anything, it was a little bit bearish because them extending production cuts is showing a little bit of a sign of weakness from the OPEC plus members, which is basically OPEC and Russia. So a little bit of bearish sentiment in the oil space this morning off of the extension of that cut. Looking over at the long-range silver chart this morning, this is going back to about the start of the year. We've got silver here at $30.55. So, just looking at a couple of things here on this chart. Obviously, this looks a little double toppy right here. That's a little bit worrying. But one thing I'm really liking as I zoom in this morning is check out the size of the wick in that candle. That was a pretty big bounce. We came down under $30 for a couple of minutes last night around 1 a.m. Eastern time. Bounced right off of it, and now we're coming up and we're positive for the day. So it looks like silver may have caught itself a little bounce this morning after a couple of big down days. So we'll keep an eye on that one throughout the day. Hopefully have another update on that tomorrow morning. Also, silver in Shanghai at 34.07. So that's down a couple of bucks from the highs that we've recently seen, but we're still looking at a $3 and change to almost $4 in arbitrage between the Shanghai price and the U.S. price, but we are starting to see that gap close a little bit. We were up just under $5 in arbitrage at one point last week. Now it's starting to shrink a little bit. So at least for the moment, it looks like the Western prices are pulling back down on the Chinese prices. We don't know how long that's going to hold, but that's going on this morning. Also, shout out to Bai Xiaojun on Twitter, who posts these updates every day. Thank you, sir. He's at Oriental_Ghost on X. And also looking at Bitcoin, having a pretty good day here, up $1,800 on Coinbase this morning, although still trading within this range that we've been at for the last couple of days here. Let me get my pen to work. We've kind of been trading in this range between 68,000 and 70,000 for a couple of days here, but catching a nice bid this morning on Coinbase, up $1,830, still below that important 70,000 threshold. So not a breakout yet, but looking like we might be on the verge of one. And now here's the big story everybody's talking about this morning. GameStop stock jumps after Keith Gill account posts shot of $116 million position. And again, that doesn't do it justice, that $116 million. That's just his position in shares. It's that massive position in call options that I think is what people are really excited about. And that's got people following him into those calls. And we're probably looking at a little bit of a gamma squeeze here. Is Keith Gill back again? A Reddit account linked to the meme stock folk hero posted for the first time in years over the weekend with a screenshot showing a $116 million position in GameStop stock, plus a big options bet. GameStop shares soared more than 80% in pre-market trading on Monday, and other meme stocks also rallied, with AMC jumping by 30%, COS advanced 16%, and BlackBerry shares up 9%. The post from Deep Effing Value account was titled GME YOLO Update June 2nd, 2024. Gill's updates on Reddit more than 3 years ago, including regular GME YOLO update posts, helped spark enthusiasm from GameStop in January of 2021. YOLO is an acronym for You Only Live Once. Sunday's post showed a holding of 5 million shares bought at $21.27, worth nearly $116 million. The post also included call options post worth a position worth $65.7 million. That was as of 12 hours ago. That expires on June 21st. Those options would allow the buyer to purchase GameStop shares at $20. The stock closed at $23.14 on Friday. The positions couldn't be independently verified, and Gill didn't immediately respond to a request for comment. So that's what's moving GameStop this morning. This is what he actually posted on Reddit. This is a screenshot of Deep Effing Value's post here. Of course, it's got 81,000 upvotes. It's a screenshot showing his position. Here's his position in the stock bought at $23.14, or at least the last price on Friday. 5 million shares. He paid $21.27 for them. So as of the time of posting, it was worth $115.7 million. Now it's closer to what? Something like $205 million. It's down a little bit from when I did the math. But then the second line here, that's the important one there. There he's got his June 21st $20 strike call options. There's 120,000 of those. He paid $5.67 for those. That position is worth about $65.7 million. Again, as of 12 hours ago, it's probably closer to $500 million now, because GameStop stock is up 70% at $39.37. I did see it as high as $41 and change this morning, but GameStop shares are surging this morning on that news. Look, just be careful, guys, chasing. This happened a month ago. We all watched this happen, and we all watched it come right back down. The companies just issued shares and diluted everybody. So I don't know that they're going to go ahead and issue shares again here, or is this gamma squeeze going to rip? All I can tell you is these things are so volatile, and there's so much dirtbaggery going on between the market makers and then people posting memes to juke the stock price. Just be careful, folks. That's all I'm going to tell you. I can't tell you what to do with your own money. Just be careful, right? We've seen how this ends before. Even AMC is along for the ride this morning, up 22%, trading at $5.28 here. So the meme stocks are rallying this morning. Also going on this morning, we got this one in Market Watch. Here's how big Warren Buffett's stake is in the entire T-bill market. And guys, when you hear about one of the most legendary investors of all time piling into T-bills, all right, that is not an endorsement of the stock market. That is not an endorsement of anything. All right, and you're going to see some of the language here. He doesn't like anything here. He's just sitting in cash. He is T-bill and chill, which is largely what I'm doing, just collecting his free 5% return. And look, on a risk-adjusted basis, he's taking no risk and he's getting 5% return. You're not going to do much better than that on a risk-adjusted basis. According to analysts at JP Morgan, Berkshire Hathaway controls 3% of the entire T-bill market. That's $158 billion in total. Berkshire Hathaway currently holds more T-bills than international organizations, stablecoin issuers, offshore money market funds, or government investment pools, said fixed income strategist led by Teresa Ho. CEO Warren Buffett seems to be in no hurry to part with those T-bills. At the May shareholder meeting, he said Berkshire's $182 billion in cash and bills at the end of the first quarter will grow to more than $200 billion this quarter. So Buffett is still selling stocks while retail buys hand over fist. Again, guys, when the big money is getting out and the retail is piling in, that is a warning sign. And we're seeing it here in big, bold letters. When asked about the cash, Warren Buffett said, "We'd love to spend it, but we won't spend it unless we think there really is something that has very little risk and can make us a lot of money," said Buffett, according to FactSet transcript. In other words, he's saying, I'd spend it, but there's nothing good to buy here. Now, Warren Buffett, normally I would say gold. Warren Buffett has this thing, he doesn't like to buy gold. He doesn't like the carrying cost, the protecting cost. So he's sitting in T-bills here. I don't mind at all under current conditions building the cash position, he added. I think when I look at the alternative of what's available in the equity markets and I look at the composition of what's going on in the world, we find it quite attractive, referring to cash. So he's sitting at $158 billion in T-bills, $182 billion total in cash. And he's saying, I'm going to sell more stocks. I'm going to add to my cash position. The big guys are getting out. And look, you can add Warren Buffett to Jamie Dimon selling JP Morgan stock, Mark Zuckerberg selling Facebook stock, Jeff Bezos selling Amazon stock, the Bill and Melinda Gates Foundation selling Microsoft stock, right? All the big players, all the richest investors in the world are selling stocks while retail piles into them. The writing is on the wall here, folks. Now let's shift gears over to China here. Chinese state media hint at possible PBOC bond selling, and the central bank won't buy treasury bonds at the moment, state media has said. Who had PBOC doing quantitative tightening during a real estate bubble collapse on their 2020s bingo card? Because everybody's sitting here right now expecting the Chinese government to start printing money and dumping it in and buying up assets a la Federal Reserve in 2020. And here's the PBOC saying, don't make us tighten quantitatively. Nobody saw this one coming. For weeks, investors have been watching for signs that China's central bank might start buying government bonds, a rarely used policy tool. It seems ready to step into the market, but as a seller, as it looks to tame a bond rally. The People's Bank of China will sell treasury bonds when necessary, the Financial News has reported, stoking fresh discussion about whether the bank should trade treasury bonds on the secondary market as a way to manage liquidity. It's sounding a little bit like yield curve control there. The central bank won't buy treasury bonds at the moment, the PBOC affiliated newspaper said, citing an unnamed source, of course, as saying that falling yields mean it isn't a good time to buy. Bond yields move inversely to prices. If large amounts of bank deposits flow into the bond market and the demand for risk-free assets keeps rising, then the PBOC will consider selling treasury bonds, the article said. And again, this is state-run media here, guys, so this is coming directly from the PBOC. That could come as a surprise to some who had expected the central bank to buy up bonds instead. And there's a lot of people out there are buying Baba stock and Baidu and Tencent, expecting the PBOC to pump liquidity into this market. And here they are saying, don't make me take liquidity out of this market. Some investment institutions have started to expect that the central bank might inject liquidity into the market through bond purchases to stimulate economic growth and inflation. An unnamed market participant told the Financial News on Thursday that spurred plans to buy long-term government bonds in large amounts in order to sell them when the prices rise. While it remains unclear what steps the PBOC has planned, the bank has mostly refrained from trading government bonds for the past 2 decades. It hasn't made a significant purchase since 2007, and it held around 1.5 trillion yuan, about $210 billion, of government bonds at the end of April. The PBOC has repeatedly expressed concerns over the fall in China's long-term yields, which have been pushed to record lows amid a months-long bond rally sparked by a flight to safety. Investors in China have been loading up on low-risk assets like gold and bond as prolonged property sector downturns and stock market volatility feed appetite for havens. This has led the central bank to issue multiple warnings about potential investment risks amid concern that asset bubbles could be forming. So China here, they're still bursting the property bubble. That's still in progress. And because this is causing a flight to safety, because Chinese investors are fleeing into long-duration treasury bonds and gold for that matter, it's driving those yields lower. It's driving those prices of those bonds higher. And now the Chinese central bank is saying, we're worried about a bubble in the bond market as a result of the other bubble in the property market. And well, we might have to pop that bubble too. And this is at a time when everybody's saying the PBOC is probably going to inflate that bubble. So no, I don't think many people have this on their radar. This is one to keep an eye on. And certainly Paul Krugman doesn't have it on his radar. Krugman says China is bizarrely unwilling to boost demand. Read that as print money and helicopter it into the economy. And of course, Paul Krugman doesn't understand why anybody wouldn't just print money. It's worked out so great for him and his rich buddies. Everybody else has suffered. But the U.S. economist says Beijing's economic model is not sustainable. China's leaders are bizarrely unwilling to use more government spending to support consumer demand instead of production, according to Nobel laureate in economics Paul Krugman. The fact that we seem to have a complete lack of realism on the part of the Chinese is a threat to all of us. Isn't that just great? Paul Krugman's like, if the Chinese don't print money, that's a threat to me. How is that a threat to all of us, Krug? I mean, these guys, I don't even want to read this anymore. This guy is such a freaking clown. Every scenario, no matter what, the answer is always more government spending, more central bank intervention, less free market price discovery. If only we just printed $1 billion and handed it out to everybody, we'd all be billionaires and we'd all be rich, right? Paul Krugman doesn't understand why a country that is struggling to recover from a large government-induced speculative asset bubble, he doesn't understand why they don't just print more money and further inflate that bubble. Well, because that's the wrong thing to do, Paul. That's why. Paul Krugman, just ladies and gentlemen, is your Nobel Prize laureate. Also, I want to send a shout out to MacroEdge this morning, who has been keeping track of all of the announcements of job cuts. They're saying here that job cuts remain elevated but slowed to the end of the month, and June has no holidays. So what we're looking at in this chart here is the number of job cuts that were announced each month going back to September of last year. And what you can see, there's obviously some noise in the chart. It's a little bit of a sine curve here, but I am noticing a pattern of higher highs and higher lows consistently here. And we just got a reading of 95,746 in May, which is a holiday shortened month. And that's off the heels of 114,000 job cuts announced in April. And keep in mind, guys, the job cuts usually peak around January because you have that pent-up demand for layoffs. Nobody wants to lay people off before Christmas. But we're watching the number of layoffs and job cuts rise here. This is a trend of rising unemployment. And I keep saying watch that 4.5% level, because I think when unemployment passes 4.5%, that's when people start to realize the Fed didn't stick the soft landing, because they told us we can get inflation down to 2% without sending unemployment higher than 4.5%. Well, unemployment is at 3.8, 3.9 right now. We're getting more announcements of layoffs. We get a jobs report this Friday. Let's see what we get. I think that unemployment rate probably looking like it's going to cross that 4% threshold. We'll see if we get an emotional reaction out of the market when that happens. Also for MacroEdge this morning, and guys, I highly recommend MacroEdge. They do great visualizations of data. Is the FDIC's problem bank list. We just got this one this morning. Now, what you're looking at, the blue bars on this chart, is the total number of banks that were on this problem list. And this goes all the way back to 2008 here. These are quarterly snapshots going back to 2008. So obviously we had a lot more banks were on the watch list after the global financial crisis. That number came down throughout the teens, and eventually it leveled off. Now, we did just have a big banking crisis last year. And the red chart here, that is the total assets in billions of all of these banks that are on the FDIC's problem bank list. Now, the FDIC doesn't say who is on the problem bank list. They just say we have a problem bank list. Now, obviously, we had a huge spike in the number of assets on the problem bank list, and then that came down at the beginning of 2023. That is Silicon Valley, Signature, and First Republic Bank failing. And obviously, when those banks fail, they're no longer on the problem list because they're not a problem anymore. He's dead, Jim. So it drops off the list. That's not the problem getting better. That's like, oh, good news. He's no longer dying. He's dead. Well, okay. I guess that's not really good news, is it? So we had a big drop at the end in the beginning of last year when all those banks failed. Now, what I want you to notice, if you squint here, you can see the number of banks is starting to rise on the problem bank list, and the number of assets is also starting to rise. So the trouble is starting to build up in the banking system again. I don't think it's unrealized losses from treasuries. I think it's commercial real estate is starting to show here. I talked a lot about commercial real estate on my update at Doomer News Network over the weekend. Shout out to DNN. You should check out that other channel. I got links in my community page should you feel so inclined. But I don't think we've heard the last of the banks here, guys. That $1 billion cash infusion from New York Community Bank, or that Steve Mnuchin put into NYCB, I don't think that's enough to save that bank. We've got plenty of other banks that are overly exposed to commercial real estate. We've got rising delinquencies in auto and consumer credit. And who knows what is going on with buy now, pay later debt. I was also talking about that on DNN this weekend. So the problem in the banking system is still building. And, I would just mention, guys, there wasn't really much warning, right? We didn't see the number of banks rising heading into the banking crisis in 2023, but we did see a big spike in the total assets on the warning list. So it's just something that I found interesting this morning. The trouble in the banks, I don't think, is entirely behind us. And I just want to say thank you so much to the Dad Dan. Welcome, Dad Dan. The DD is now a member of the Melonheads. Thank you, sir, for supporting the channel as a YouTube channel member. I appreciate that very much. And thank you to my buddy Steve Woitis, who says government fiscal stimulus is running out. Where will liquidity come from to keep assets inflated? So look, Congress won't approve any government stimulus, so you won't get any CHIPS Act or Inflation Reduction Act. But keep in mind, the CHIPS Act and the IRA money, it hasn't all been allocated yet. It hasn't all been spent. It's just been approved by Congress. So you can still get some of that liquidity pumped into the market. You can still get some of that fiscal spending. We're getting another student loan forgiveness every week. It's a few billion more, right? So that's coming out. We've got things like UWM, United Wholesale Mortgage, announcing this new no money down second mortgage for 3% for a down payment program, injecting liquidity into the housing market. That's going on. Defense spending. Look at it this way, guys. Every time you see a story about a country that's sending F-16 to Ukraine, I'm not trying to get too political, but let's look at the business end of this, right? You've got like Hungary and Poland are announcing we're going to give F-16s to Ukraine. And then if you go look within a few months of all of these announcements, you'll find an equal or greater number of F-35s those same countries are ordering from Lockheed Martin. So just the money the aid that's being sent to Ukraine is old equipment that's being fed into the meat grinder, and it's being replaced with orders for new equipment. Well, that is stimulative. That is inflationary. That's increasing demand here in the States. And so that's also one of the ways the military-industrial complex is pigging out off of this conflict. So there's plenty of ways this phantom liquidity could appear. And again, the buy now, pay later, that's a big variable. We don't know how big that is, Steve. They're saying $65 to $70 billion, but it could be 10 times the size of that because we've got like $600 to $900 billion of magic new liquidity that came out of nowhere in the last 6 months. It didn't come from banks and it didn't come from the Fed. So where did it come from? Maybe buy now, pay later is a lot bigger than we realize, or maybe private credit is just loaning money into existence. I don't know where it's all coming from, but there is ample liquidity. Financial conditions are still very loose, and so asset bubbles can keep rising in that scenario. Thank you very much, Steve. I appreciate the super chat and the support of the channel. And thank you so much to Cole Marsh for the super chat. He says, happy Monday, you dirty melon heads. Right back at you, Cole. Happy dirty Monday, you dirty, filthy animals, all you guys. And thank you guys for watching the Morning Update Live. I appreciate your time very much. Thank you to all my melon heads and channel supporters on Patreon. I got links down below to all that good stuff. Should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Everybody, until next time, live small and dream big. Thanks again, Cole.